Hi guys, welcome to my channel, and today we're going to be talking about AUE 1501. So the first learning unit wants us to talk about the various types of business entities. So before we talk about those business entities, you just have to understand at the back of your head that a business simply means a combination of activities. So if you have a combination of activities, that combination is what they're calling a business. So combination of activities is maybe someone coming with money, and after coming with money, they get a good or they purchase a service. So that blend or that mixture of activities is what is referred to as a business in its simplest or in its simplicity form. So in its simplicity form, from then onwards, we have to go on to what the study guide is saying. So remember, if you want the study guide, you have to go to Telegram groups, or by the time that you're using this, you would have registered for the module. You can just utilize the module that you would have, the module resources that you would have received from the institution. Again, I'm not going to be pasting copies and types of things, the page numbers on the channel because of copyright infringements that I might attract due to the property, the study guide being the property of UNISA. So the first type of business that you just have to be aware of is a sole trader or a sole proprietor. So a sole proprietor is a person or is a business that is owned by one person. So it's basically lying the meaning to it lies on the types of ownership or how that form of business is owned. So if the business is being owned and operated by one person or a natural person, meaning an individual person, if it is a person who's operating this business, it is called a sole proprietor, and there has to be one person to it. For an easy example is what you see with a spaza shop. So with a spaza shop, what will be happening with a spaza shop, there is usually just one person. So if the person is sick that day, the spaza shop is closed. If they went to get stock, the spaza shop again is going to be closed. So that is what is a sole proprietor. So it comes with various advantages and disadvantages. Amongst the most of the advantages of a sole proprietor is it is easy to set up, right? The owner is going to get all the profits and you can easily close them if you want to. The main disadvantage to this form of business is you are the only person there. So the business is limited to the skills, which are the skills of the individual owner. And as well, the debts of the business automatically become the debt of the owner as well, because he is the business basically. So moving right along, we have what they're calling a partnership. So a partnership is a relationship that exists between two or more people. So you cannot have a partnership alone. A partnership, it has to be two or more people, and the limitation to a partnership is, I think, is about 20. You can have 20 partners in a partnership. In certain special circumstances, you can have more than 20 partners, but usually it's 2 to 20. Unless you are dealing with maybe accountants or attorneys, they can have partnerships which go beyond 20 members. But what's happening with the partnership, it's still the same as a sole proprietor, in the sense that the debts of the business are the debts of the partners. Like, there's no telling apart between the partners and the business. It's just the same. So what are the advantages of establishing a partnership? The advantages of establishing a partnership are it is simple to set up and manage, and it has greater financial strength, meaning there is more money, more people, which means you can pull more resources. And all partners are entitled to be benefiting. That's the major disadvantage to the partnership, or to having a partnership, is it's not a separate legal entity. Meaning, because it's not a separate legal entity, there are going to be issues where if there's a debt on the partnership, or the partnership makes a bunch of losses, the people whom you now owe money can come for the partners, and they come to claim their monies from the partners individually on their own personal capacity, meaning they can even take your house, they can take your car because of the debt of the partnership. At the same time, also another boring thing regarding partnership is the moment one person exits the partnership, you have to dissolve the partnership and start again. The moment another person wants to be admitted or entered into the partnership, you have to dissolve the whole thing and start again. But the major advantage is, okay, it's very simple to set up and manage, and you have more people, meaning more monies. But the moment you want to change it, you have to dissolve. And when you change again, you also have to start and get a new name, all in all. Another form of ownership that you have to talk about is a CC, right? So with a CC or a close corporation, it is also another simplified form of business, which is like a small company or a small private company. But the only thing that you just have to understand is, in a company, we have shares, and in a CC, we have shareholders, and in a CC, we have members. So you just have to make sure that you know the distinction between the two. A CC is a close corporation, and there will be like a corporation of people who are doing this thing, and they will be benefiting, and the beneficiaries of that CC, they're usually called members. So with a close corporation, you have to understand that it is a legal entity, right? Like it is its own legal personality. What that means is, when the law looks at a CC, they look at it as if they're looking at a real person. So basically, a CC, the debts of the CC are not the debts of the members. So basically, there's a distinction between the two. A legal entity, legal meaning when the law looks at a close corporation, the law regards a close corporation as an individual person, meaning you can sue a CC individually. You don't have to sue the director. Let's say you receive bad service from a certain CC, you cannot sue the director in his personal capacity, unless it's an issue which is relating to his person. But if it's relating to the business and the service that you've received, you have to take the CC to court. And when you take the CC to court, if you win or you lose against that CC, you haven't lost against the person, meaning the director or the manager who will be acting on behalf of the CC is the one who's just going to be maybe answering on behalf. But there is no liability which crosses to the members of the CC. So the members, when they have an interest, it's expressed as a percentage, meaning you might own 10% membership in that CC. Another one might be owning 20%, another one might be owning 1% and stuff. So one thing that you just have to also realize is, as per the 2008 Companies Act, it is now not permissible for you. You cannot register a new CC, and the current CCs have to be converted into companies. However, if you do not want to convert your CC into a company, it's still fine. You can continue on operating, but you cannot open a new one. You cannot open a new CC from the scratch and with memberships and all of that. The Companies Act has now made it easy for people to register companies rather, but move away from the CC. So the disadvantages to having a CC is there's a restriction of 10 members, right? So you cannot get into, if like you come across a person who also believes in the vision that you're pushing, they cannot join you because of the limitation. So that's something that is very, very problematic in case of where you would want to expand and where you want to grow any further. Advantages, it's relatively easy to establish and operate, but it's no longer, that's a very funny reason that they put up there, because it's no longer easy you can no longer establish a CC. So you just have to be book smart and just understand, you just have to know that advantage just to pass. Members have limited liability, meaning they are not liable to the debts of the CC. It's limited to the interest. It's limited to the interest that they would have put in to the business. Something that you also have to also understand is the transfer of ownership is also easy. You can then, another member can come and replace you and stuff after meetings have been established and all of that. But that is basically it amongst the CC. What you have to remember is there's a maximum number of members, which are 10. And the people there who own the CC are called members, they're not shareholders. And there is limited liability. If you remember those, then you should be fine regarding a CC. So the next form of ownership that they want us to talk about is a company. So with a company means a juristic person incorporated in the terms of the Companies Act. So basically what this means is we have to talk about this juristic person and all of that. So basically if you get into an altercation with me, you can take, it will be me versus you. Basically you'll be taking Felix versus whoever. Then when the court looks at Felix, it will be saying Felix is a natural person, right? So when the court looks at a company, like the registration documents and everything that will be happening there, when it looks at a company, it calls that company a juristic person. So that's the difference. There's a company, the company is then called a juristic person, and a human being is called a natural person. So the moment that this entity is now being called a juristic person, you have to also understand that it becomes a separate legal entity, meaning the shareholders of the business or of the company, which are the owners of the company, are the ones, they are not personally liable. They are only liable up to the money that they have invested into their company or the resources that they've invested into their company. And that will be it. You don't go beyond the liability which is stipulated. That's why he's saying the company is, that's why they say the company is a separate legal entity, meaning the affairs of the company are the affairs of the company. The affairs of the individual who might be the shareholder becomes the affairs of the shareholder. So there are various advantages and disadvantages of owning a company or of creating a company, meaning the life of the business is perpetual, meaning it continues even though one director or one shareholder might die. You can continue having the company with the same name with the other shareholders, and you can easily sell the shares to other people, and those people become the new owners of the company. That's why we see companies like Coca-Cola, KFC, and all those other companies continuing, because the life of a company is prolonged, because it is very, very easy to transfer ownership from one person to the next person to the next person. Then one of the disadvantages that you just have to keep at the back of your mind is it is subject to many legal requirements, meaning you need to you need to have, I think, relating to South African companies, you need to have your ID, a specific name, and you have to open a bank account, and to make sure that the directors are not also disqualified directors as per the CIPC, and a lot of things that you just have to consider before opening one. But it is easier to open a company. It is easier to then manage a company, because you can always hire more people with you can always attract more people with who have more skill or who have more capacity than the one that you have. Companies are then split into various categories. We have what they call non-profit organization. We have also what they call profit companies. So non-profit organizations, these are companies which are mainly for the benefit of the public, and their sole goal is not to make profit but to just benefit the public. And profit companies, these are companies which are established namely for profits. Those are the ones that are being referred to as profit companies. And we continue on to go on and talk about state-owned companies, those are companies which are owned by the government. We have public companies, meaning these companies are listed on the JSE and the shares can be publicly traded. Right? Then we have private companies. Private companies, these are companies that might not be listed on the JSE, and they do their affairs internally and stuff, but they still fall under the same bracket of private company. Personal liability, this is just this is a profit company that satisfies the criteria in the section whatever. It is the same as a private company. There is really not much distinction between the two. So why is it important for you to start and understand the first chapter? You will not be able to perform any audit of an entity which you don't know. Meaning, when you get to a company, we should be, after this, basically the whole objective of this video is to get you to a level where after this video you are supposed to know what form of a business is this. When you get to a sole proprietor, you'll be able to identify, okay, this is a sole proprietor. If you come across someone who's driving a taxi which he owns, and when he's sick, the taxi is not there, and when he's feeling okay, the taxi is back in business, yeah, you're dealing with a sole proprietor. If you get into a franchise, your McDonald's, your whatever franchise that you come to, And when you get to that franchise and you see it again in a different location, just to give you a hint that, okay, what type of a business this is. You come across a company and it is actually also written at the end CC. CC meaning close cooperation. You should be able to tell at the beginning, okay, what type of business this is. So this is a very important learning unit. Make sure that you understand all the forms of ownership that you have. Make sure that you thoroughly understand them, because it's going to affect you as you proceed in your studies with auditing. You have to know, okay, what type of business am I auditing? Is this a sole proprietor? Is this a partnership? Is this a close corporation? Is it a company? If it's a company, what form of a company is this? Is it an MPC, which is a non-profit organization? Is it an SOE, which is a state-owned entity? Is it a private company? Is it a personal or a private proprietized? They mentioned there. But the moment you have this and you're proficient, you'll be able to answer your questions more accurately. Please also make sure that you continue reading your notes, the notes that they've been given on the study guide, and they also have some assessments for you. Please make sure that you also go through those assessments, and make sure that you like, subscribe,